Cool. So the recording started. Yeah. So hello. Yeah. And thank you for the really kind introduction as well. It's my second time I'm doing this for COVIDx program. And I'm really excited to meet you guys because today I'm just going to give you the theory part and the practical insights that I have had during my career, how to attract public capital and what are the tips and tricks to do that. But basically each case is still different, right? So you're in very different development stage. Last time I know that there were very mature companies who were already successfully have fundraised a couple of financing rounds, and the others were struggling to get the first one. So I guess those individual sessions are going to be more valuable potentially, because then we can really elaborate on your case specifically. And if you have the time to fulfill this spreadsheet Excel table as well, then it would be very helpful for me to get instant insight, what is the financial structure that you have and what are the fundraising plans that you have. I know that already a couple of you have sent me out those spreadsheet tables as well, because I got some email notification about that. I haven't checked them out, but I'm going to do that today, later, definitely. But yeah, maybe then without further ado, I'm gonna share my screen as well, because I have the slide deck prepared for you guys. And as mentioned, then today we are going to focus on financial planning a bit, why it's rather important for startup companies. And then the majority of the time we're going to spend on how to attract the correct type of private capital, how to distinguish the right type of investors for you. How are the investors mostly thinking? What are they expecting from the companies to have? And what could be the perfect match between you and the private capital there, and what you need to prepare in order to fundraise successfully. We have 1.5 hours for this session, and we are going to leave a couple of minutes or 5 to 10 minutes afterwards as well. So if you have first-hand questions right away, or maybe you found something difficult in filling in the spreadsheet that we send out to you, then you can address the questions right away as well. But as I mentioned, the most valuable part would definitely be the one-on-one mentoring session that we are going to have, because then we can discuss your cases more in detail and more specifically. But yeah, if you want to interrupt me, then do that anytime. So if you have very concrete questions about things I'm elaborating here, then just let me know. I'm not going to follow the chat too much, so just open up the mic and make some noise. So about myself, yeah, the majority of my time I have spent at Tallinn Science Park Technopole, and basically we are helping technology-based companies in health tech, green tech, and deep technologies to proceed quickly to export markets and fundraise successfully the capital that they require. And throughout those years, I think I have worked together with 200 or 300 companies, which are in different growth stages. They can be early stage startup companies, but also already quite advanced scaling companies. And basically the quest for the companies is almost the same, nevertheless, which is the development stage that they are entering. Because launching a tech company, it's quite a capital intensive thing, because you need to proceed rather quickly. You need to have external capital to do that. And the capital demand is something that is basically orchestrating each and every growth of each and every company. So I've been connected to very many tech companies during this Technopole career and time here. I'm also the member of Estban, which is Estonian Business Angel Network, where we mostly invest in pre-seed, seed stage companies, making syndicated investments. I have a small micro portfolio of 15 different tech companies where I have invested in early stage and carried through with those companies onward as well. I'm rather hands-on investor in that sense, that I strongly believe that if the investment decision is being made, then you need to have like additional value for the company as well. So I try to be as hands-on as possible to support the founders in later stages as well. I'm also engaged to a couple of cool things. One of them, it's Prototron. It's the equity-free grant funding mechanism in Estonia, which basically supports the early stage companies in building up the prototypes of their products or MVPs. And this is basically the competition-based money, but we still grant the companies quite an extensive fundraising grounds for proceeding. I'm also in the board of Latitude 59, which is one of the most amazing tech conferences in the region, one of the largest ones in Estonia, definitely. And there we try to like be as hands-on as possible to connect like startup companies and venture capitals and make those potential matchmaking activities happen and have a very good like real life attraction of the companies who can like fundraise during the conferences as well. And yeah, besides that, in the earlier stages of the career, I have been more related to IT companies, but also established one advertising company, which I successfully exit back in 2006 already. And after that, I have been like more attached to startups, to scale-ups, but very specifically in high-tech verticals, as mentioned, green tech, health tech, and deep technologies. So let's start off. As I mentioned, I'm kind of elaborating more in the first phase, like why the companies would, startup companies mostly and tech companies, why do they require pretty different and pretty well thought financial planning, and what is the urge for the capital for those companies. And on the second part, I'm going to tell you more about like those financial planning specialities, but also then fundraising and how to interact with investors. The majority of stuff I'm covering here, it's not from the like textbook so much. I have more or less relied on my own experience in working with companies, because I think that textbook wisdom is something that you can tackle independently as well. So I'm more trying to cover this practical side of this equation and my thoughts about that. So this is the main reason why I definitely encourage you to jump in if you want to have the discussion on some specific topics there. But yeah, the very basic stuff. So you're all the founders of the startup companies. And as you probably have noticed, then you're working with really limited resources, right? So you don't have too much time, you don't have too much money, you don't have too much human resource at hand that you can use. But the quest you are all like going for, it's finding this scalable business model or scalable product or service with what you can enter to global markets right away. And the good thing is that you move potentially rather quickly compared to corporations, for instance. But the bad thing is that this competition is rather tough, because established companies already have the resources at hand. They can react if you make the move on the market, and you need to be rather smart there. And the competition is there from the very beginning. So you don't have like a head start or something. Like the very moment you are launching the product, you are in the competition, and you need to like sustain this edge that you are having in front of the competitors as well. And the resources are limited to do that. And as you probably know, then yes, 90% of the companies tend to fail. I like to believe that around 1/3 out of those failures are related to the ability to fundraise, or the lack of the ability of the companies to fundraise, or to think ahead how the financial sustainability should be achieved. Because the urge to market is rather like quick for the companies. They want to work with the product, they want to work with excellent teams, but it all requires pretty awesome financial planning as well. And you need to like build up the runway as extensive as possible. And this runway management is already something that a lot of companies are failing in doing. So I guess this 90%, like 1/3 of that, can be like related back to this topic that we are covering today here. couple of things I want to highlight before we really move on to the very essence of the presentation. I just want to like present you this quick perspective of my thinking. What is the main like difference between a startup company like you and a normal or regular established company? Then number one criteria that you need to keep in mind, it's definitely to do with the very beginning. Like, first of all, startups are all about tests and testing. So you try to build the MVP as quick as possible. You want to get the instant feedback from the market. You are launching something, you get the feedback, you go back to the sketching board, you try again, you make the amendments, you test again. So it's all about the number of tests basically that you conduct in order to get the traction going on real market conditions. But if we're talking about like regular companies, then they are mostly about like sure small revenue that they want to like make right away. The product itself, it's quite crystallized. They know the customers that they are tackling, and they are basically doing the things that somebody else has already done before. You, as on the other hand, you are mostly pioneering, and this is the main reason why you need to like be all about like quick testing and to be quickly out there on the real market conditions. The second thing to consider, and it again goes back to this fundraising topic as well, it's this product development part, because you normally don't have like this very crystallized idea about the service or product that you want to introduce to the whole world. Whereas the regular companies normally know what they are doing. They have rather fixed product portfolios, and the amendments or changes that they are making in those portfolios, they are very much like considered and slow. So you have the competitive edge there, but still you need to like be rather smart there as well, because companies and startup companies mostly, they tend to overinvest in product development. They don't really like understand what features or functionalities are the essential ones, and what are the ones that can be like considered as like bells and whistles that can appear in later growth stages. So you need to like focus on the very essence of the product and the functionalities, and you need to keep in mind that product development is something that is ongoing all the time. You never have the like really ready product in your hand that you are like happy with and that you can like sustain without like within like 10 years of your operations. So you always need to like keep that in mind, that the investments that you are making in product development, they should be like very much considered as well there. The third thing, huge difference again, is the business model side. You potentially have covered this side during this acceleration program as well, but as you probably know, you're always in search of the perfect model, how you're making money. The good thing about startup companies is that you have plenty of different opportunities. Like you can have like, I don't know, you can sell your software subscription-based, customer-based, user-based. You can have like monthly payments, annual payments, license payments. You can have like installation costs, training costs for users. So very many different things that you can charge basically, and you need to like find this really good balance. And the good thing to consider there, it's the unit economics. So you need to like understand like what is the effort of serving this specific type of business model, and what is the outcome in terms of financial planning. So again, something to consider, that nothing is crystallized there. You can always change the way you are making money. So if the financial plan is not coming together right away, then you just need to go again back to the sketching board. You need to be smart about your business model, make the amendments there so that the unit economics make sense. And regular companies, they normally have this price list. They know what they are doing. They know how much is the cost of production. They know what is like the marketing costs, the overheads that they have, and what can be like the value added for the end customer, and what is the price that they need to ask. And they are like pretty straightforward with that, and don't really like to like bend around too much with the business model, different angles and opportunities out there. The fourth thing worth considering here, it's definitely the need for the investment, because we started off with describing the very essence of the startup, like how the resources are rather limited and how you can't really proceed quickly without external capital. This is absolutely true because doesn't really matter whether you fundraise from public or private sources, you need some type of external like money, and nobody is giving you loans because the balance sheet doesn't really like support that, and then you don't have any traction to rely on. So this external capital is the only source basically besides your own funding that can be injected in the company in early stages, and something that you can rely on when you want to like scale up quickly. Whereas the regular companies, they normally tend to move slower, and all those like expansion that they are taking on, it's mostly revenue, profit, or loan based. So if they have like the balance sheet that supports the loan, then they are using that, and then this is the main reason why they tend to operate and expand rather slowly as well, compared to startup companies, which immediately like fundraise the capital and go to global markets based on this capital. The final thing I would like to emphasize here is that because of this highly demanding capital requirements that the startup companies normally have, then the founders normally get diluted rather quickly as well. So each time if you take in the capital, there is going to be dilution that affects the founding team members, and the investors are going to be the stakeholders. The investors are going to be there in your cap table only because they want to see higher returns, and exit is something that eventually comes for each and every startup company. They might go public, there might be like payoffs by the competition, there might be like, I don't know, payoffs from the investors and so on. But basically the founders growing the company, they need to consider exit as a strategic end goal for a startup company as well. And then the reasons are rather simple. As I mentioned, the cap table is going to be very much crowded. There are going to be investors, there are going to be you as a founders, there are going to be other stakeholders, key personnel, and so on. And eventually, as a founder, you find yourself in the situation, normally in PRC funding rounds already, where you don't really control the future of the company anymore. And the reasonable thing to do there is that if you have already built something so valuable and huge, then the exit value is going to be rather big as well. And normally the founders like cash in the capital and then do something else, like, I don't know, start investing in companies or start like establishing new companies because they have like rather good experience already. But the exit is something that you shouldn't be afraid of. It's quite like logical and normal thing where you find yourself in. And whereas the like regular companies, they are more in sustainability, like they want to like be in control. The founding like partners normally have the control over the company, and they have achieved that just because they haven't taken in too much external capital. And then this is rather okay as well. But again, if you want to be out there and grow rather quickly, then this huge exit value is something that you should be after. Because yeah, if we are like considering the unicorn companies of today, like, I don't know, for instance, if we take like Bolt, then I guess the founding team members, they hold something between 20 to 30% of the company, whereas the other like 70% is already allocated to strategic investors and other stakeholders. And this is something that gives at least me the indication that Bolt is going to be public anytime soon, and we can elaborate on the time frame there, but potentially within a couple of 2 years or so. So again, exit is something to keep in mind as well. So to sum it up, then startups, they require basic rock fuel in order to expand rather quickly. And then this is the balance between the revenue that they are making and the burn rate that they have. And normally the burn rate is higher than the revenue or income that the startup has. And then this rocket fuel that you require, it's the investment. Again, doesn't matter whether it's public or private capital, but it's external one. if you don't have that fuel, then it means that it's going to take a longer time for you to expand. So all the like strategic personnel that you are seeking, you can't afford them. The product development that you want to conduct, you can't afford that. The expansion to export markets, it's really costly. You can't afford that at that very moment. So if you don't have the capital, the expansion is basically on hold, or you are doing that rather slowly, and more time to market or more time to expand. It basically means that you are very much in the position to lose your competitive edge as well, because if you are now like building up a rather strategic like product or service, then you potentially have like a very good opportunity that you are the first early mover, you have the first like product as such in the market, and potentially the gains that you are going to have are rather peak. But if you are in stealth mode and you expand like rather slowly, then it means that there is going to be like more competition in the area. Somebody like hears about the product or service you're developing, you potentially can't protect that too much, and there is a rather high possibility that somebody is making very similar like value proposition for the customers, and you lose your like momentum on the market. It also goes to technology, like you can build your products or services based on specific software or hardware, for instance, and if there are like new technological advancements on the market, then you need to like switch the platform and make the amendments again, which is rather costly to do, and also rather time consuming for especially for the startup company. And the value proposition as such as well, because for instance you are like struggling the COVID situation here, but what if something changes in the course of in the market, then potentially your value proposition isn't too valuable anymore for the end customers. So you need to like keep that in mind as well, because in longer time periods markets tend to change, and the way people interact with your specific product or service, it might be very different within only a couple of months or half a year time. So yeah, quickly to sum it up, then you need to have external capital to expand quickly. If you don't have that, it takes more time, and more time is always bad for the startup company, because startup companies are mostly about innovative new technologies, tackling the market demand at this very moment, and considering the competition environment around them as well at this very specific moment. So in terms of external funding and the failure rate, it all makes sense for the industry, because yes, you are taking like higher risks, and the investors or external capital providers, they have high gains in the company as well, and it works basically both ways. Even though you might have like the 90% of the chance to fail, then the investors see you as a pretty awesome cash machine, providing like 10x returns for the investors. And this is the risks that both parties are willing to take, like the founders, the quick expansion risk, and the opportunities to fail in different like development stages there, but also the investors that don't want to have their assets in conventional like asset groups, but they want to like take these risks with you because of those higher returns that you potentially are going to bring them. So now moving on to the like the real part of the session here. So I'm going to cover a bit on the financial planning side. Again, we have sent out this spreadsheet, which basically gives you the practical opportunity to fill in the form and see how the financials come together. But maybe just like some comments or insights how this should be very well. So as I mentioned, it's all about like management of the runway. So the runway is the capital that you hold right now, or the money that you have in order to get you the traction on the market, or to have the revenues and profits that you expect to. And runway is always short. Like I have never ever seen a company that has a very solid and good runway for the next like 3 or 4 years, where they can feel convenient, invest all the money they want to in R&D, hire whoever they want to. It's only like the luxury for limited like established companies, but definitely not for startups. And this runway management is something that is normally considered as financial planning, but it more like represents the startup mindset here, I guess. So it's all about like planning your revenue, costs, profit, and external funds. And external funds, again, I would like to emphasize that part, because revenue, costs, and profit, it's something that each and every company is planning in their financial plans. But the external funds, it's very characteristics to startups, and especially if we take like this COVIDx program or health tech companies in general. Like if you have like deep technology in the pattern of your product or your service that you want to initiate, then normally those external funds are something that gives you the opportunity to work in with the R&D that is required to launch the product successfully. And it's nowadays, I think during the past like 4 to 5 years, it's very characteristic for the companies to match private and public capital, whereas the companies can apply for different grants. They can be like local ones or pan-European ones or global ones. And normally the majority of the development money comes from public sources. And this money is being like matched with private capital. So I definitely urge you, like if you are like filling in this financial plan, don't consider only private capital as the opportunity for you to expand. Try to keep in mind all these public opportunities as well. They can be small, they can be like related to some type of competitions where you need to enter. They might like force you into collaboration with different consortia and partnerships, but still, if you're running like R&D intensive projects and you want to invest more in R&D, then public capital is something that you need to be have there as a part of the funding scheme or strategy. So this is like rather essential to have this public capital side covered there as well. Normally, I urge the companies to have like at least 3 years of the financial plan and predictions, but the very fact of the matter is that nobody is really capable of doing that. So normally companies tend to have like this financial plan for the upcoming half a year, maximum 1.5 year, but the predictions for longer time periods, they are mostly considered to be something that you keep in mind, that you present to the investors, that you want to achieve. But as the working kind of spreadsheet, you should have like a shorter time period view, because as you probably know, like the product development, rather complicated, unpredictable. Even like if you have done that already for years and years, still like the market situations tend to change nowadays rather quickly. So you can't really predict like the costs there too accurately. The same goes to go-to-market, because the revenue base that you are going to have there, it's very much related to the value proposition, the customers that you can engage, and so on. And normally companies tend to like underestimate the time to market, and this is the reason why this financial planning for a very long time period doesn't make sense as well. And as we mentioned in the very beginning, the business model might change. The pricing might change, the functionalities and features of the product might change, and maybe you end up with more meaningful product feature that you can charge like higher in the market conditions, and so on. So if you can't predict 3-4 years, that's okay, but try to keep this like runway management or financial planning as your everyday like tool or like sketching board that you have in front of you all the time, and then try to make amendments basically as you play around with business model canvas or something like that. So if you learn something, then try to fill in the spreadsheet and you have more accurate numbers in there, and it's rather okay. You don't need to have like annual plans like regular companies do. Predictive planning is always good. So I always urge the companies to think ahead about the capital need, especially the external funding need that you have, because if you already have rather short runway ahead of you, like you can maybe like finance your development for the next like month or two, then it's a very bad position to fundraise external capital, because the time period is rather short. The investors will like understand that there are problems in your funding curve, and they don't want to have additional risks in there, and they want to make sure that you know like how to survive this short runway period. So try to plan ahead quite exactly when are you going to need the external capital. Again, like you can predict like the costs for the product development, the sales, business development, sales and operations, and the financial plan immediately shows you where you basically run out of money, and there you need to like present the milestones where you are going to fundraise external capital. And if you already have set those milestones, then you really need to like put together the capital rounds as well. Leave yourself decent time to react, because funding problems can be like predicted quite far ahead. So if you have like weeks left or months left, then it's a rather bad position as I described. So reacting within like solid time frame is something that you need to understand based on this Excel spreadsheet as well. And definitely like founders need to be like out there all the time. And if we're talking about like fundraising these external funds and capital, then you can't really be idle. And then normally if you like divide the kind of the tasks within your small team, then somebody is always responsible for external fundraising as well. Doesn't really matter whether it's again public or private. Somebody is there who is basically making the preparations or preparing the company for the fundraising, and puts like a decent amount of effort in there. And by effort I mean time and money basically. The things that you need to like predict, as I mentioned before as well, are related to the product development, business development, sales and operations. So those are those cost lines that you should be able to predict if you are planning this runway ahead of you. And if you can put the price on each and every criteria out of those, then you can rather well predict when you are going to run out of the cash as well. So try to keep those things in mind. Bootstrapping is something that you should be awesome as well, because external capital always comes with rather high cost. Doesn't really matter whether it's a loan mechanism that you are using or equity investment that you are using. There's always the cost, and if you fail to deliver the milestones and KPIs that you promised to the investors, then normally the second or third tranche of money doesn't come so easily, or it doesn't come at all. So try to keep in mind that if you are planning your financials, or if you are planning your product development, sales and go-to-market and overheads, like parts of that, then try to move from measurable milestone to milestone, or from KPI to KPI. Like for example, like if you have like one paying customer today, then if you fundraise, let's say €500,000, how many paying customers you are going to have in 1 year or 2 years? Because investors are mostly investing in based on those KPIs, and then they want to see that the unit economics comes together, and you have thought of each and every angle of the product development and the personnel and all the cost structure that you have. And as more thorough milestones you can provide there, the better. And it's always bad if you like overpromise something and you under-deliver, because that makes the investors, even public investors or public like grant schemes, it makes them more suspicious about like your further proceeding. So try to be as realistic there as possible. Like if you know that, okay, your product needs desperately some type of features, and if you can't manage to develop them, then there is going to be no traction, no customers, and no nothing. Then try to predict like what are those critical milestones in terms of your product that you need to achieve with the investment or grant, and how much of the traction or revenue those features are going to bring you. So try to think of this financial planning or your roadmap or your runway going from milestone to milestone, and those milestones should be understandable for investors or grant organizations, but also to you and also to private capital investors, because they normally tend to invest in those sprints that you want to make. You should be like as low cost and high performance machine as possible, because startup companies don't have the luxury to hire too many people to work with them, and they don't have the opportunity to hire maybe the best people in the market. So you need to consider as yourself in the bootstrapping phase at least, or when you are like starting to fundraise the capital, as a really high performance machine based on the resources that you have. And this is rather important as well, because if I elaborated a bit more on those milestone like part of the equation, then again this realistic part should be covered there, because normally like startups paint the picture in their financial predictions and fundraising plans that, okay, today if we fundraise like 1 million, then we are going to hire all the professionals in the market, and then we are going to be successful. But it doesn't work like that normally. You need to like prove that you are like goal-achieving team already before the investment, and this is basically the time where you need to like spend a lot of time to prove that. Like this is a reason like why the startup founders have like 14, 16, 18 hours work days and so on. So you need to show that this high performance is something that is already in your DNA, and if we like amplify that with private or public capital, then you are going to be like more successful, and it can be measured as well. The founder's commitment and engagement is relevant, because you are pretty hands-on there. You need to fulfill all the tasks there. You can't like hire too much people, as I mentioned. Attracting the free money is something that is very important during the bootstrapping phase, because as I mentioned, those grants that you might have, these startup competitions that you can enter for free and equity free money, those are the lowest hanging fruits for you. And as long as you can like prolong taking in like equity investment in the company, the better for you, because the valuation of the company goes higher, and the progress that you can have based on free money or equity free money it's very essential, because it kind of gives the perspective to the first qualifying capital rounds, and then what is the valuation of the company if you are doing this fundraising there. And yeah, the ultimate goal during this bootstrapping phase is to get yourself investment ready, like to have all the bits and pieces together, have the financial plan together, have this like high performance in your DNA, and maybe using already like some free money grants to increase the company valuation. And then we can like easily say that you are like private capital ready, and it's a good position and time to fundraise. So am I investable? It's always like the question that companies ask, like if they are approaching the investors, then the investors say no, then there is always the question like, why? I'm so great and I have an awesome product and I'm doing rather good. So one thing you need to consider is that the investors normally say no, because there are very many like prospects in the deal flow that they are screening, and they normally have their own strategy. They normally have their own like strength where they want to be part of. And this is the reason why they are making like different selections, because of their strategy and background mostly. But normally the company is quite fundraising like or capital raising ready if they have an awesome like founders team that is committed, that is performing really well. They understand the market, like what is happening in the market, why we're entering this market, and how we can enter this market. And they have this product that is somehow unique and that basically solves the problem that are there in the market. And if those like three bubbles are there, then there's those like matching points. So if there is an awesome product and the founders are really good and technical, for instance, then normally the company holds a very good IP, or it doesn't really mean like intellectual property, but the know-how in the company, how they are doing things, how they are like developing and building the product or service. If the founding team has like very good market insights, and then maybe they have the background in working in, I don't know, competing companies there, and they understand the market very well, then there is like this awesome go-to-market plan. Like normally they know how to engage the customer and what is the value proposition that they should present. And if the product and market are very strongly represented, like the product is very well thought and specially designed to serve this market need, then the product market fit happens, right? And then if all those parts are like covered, and then the founding team is equally strong in each and every bubble in there, then this is basically the point where this magic happens, and where the investors are basically overbidding that they want to invest in the company. Because again, like if some of this acumen is like missing from the company, then again, the startup should have like a decent plan how they overcoming this weakness that they have, or at least they should have like the understanding, like if they fundraise, how or what they are doing differently in order to amend this weakness that they have. But yeah, these are basically the criteria that the majority of the investors are benchmarking you in the very beginning. And you also need to like understand in which growth stage you are, because you might have like a very awesome product idea. You might have like understanding about the market because of your background. And as a team, you perform like pretty good as well. But still, if you are in this idea phase and you haven't like built anything, then normally the investors tend to say no, even though the bubbles are covered. If you already have like this minimum viable product, and the vision and founders fit is there, the product and market fit is there, then already the engagement from the investors can be achieved, because they, based on the prototype or MVP, very many investors already make positive decisions. So this is basically the phase where the investor engagement can be achieved. And if you have already like proven track record, and basically you have already proven that you can make money, you are able to grow the revenue by doing this very thing that you are doing, then the majority of investors are on board, and they always want to invest in like scaling companies where the business point is already proven, the team have performed, and the risks are rather low, and it's basically like a scaling machine, and it's a rather good like position to fundraise. But it doesn't like necessarily say that you can't fundraise before, because there are R&D intensive projects in the idea phase that basically have fundraised public capital, and they want to match make that with private one. Then the investors in most of the cases want to mix and match there as well. So if the risks are shared there with public capital, then private capital might jump in the lower positions as well. And it's always opportunity to search for right type of investors. Like, for instance, if you have an awesome product idea and you know that no business angel or venture capital firm is going to back you, then maybe you should go for crowdfunding, where you basically sell the product idea that you have, and you are basically fundraising to produce the first tranche of the product and so on. So you just need to consider that you need to understand in which growth stage you are, because this saves you a lot of time, because you can approach the very right type of investors who are capable and willing to invest in this specific phase. And the funding or financing cycle that you have probably seen as well. So firsthand, it's going to be more about like angels or friends, fools, and family who are basically providing you this seed capital. You are normally struggling in this very financial phase, then it's going to be mostly venture capital companies based like stage investment. So there can be A, B, C rounds, whatever, mezzanine, for instance, for later stage growth, and so on, till the IPO or going public, basically. And to have like a really child simple approach on that, then This is a table I have been like using. So I guess within like the last couple of years, the prices of the companies and the valuation of the companies have risen a bit. So I mean, the valuations and the investment rounds have increased throughout the time as well. But normally, if the company valuation is like 500,000 to 2 million, then normally the investment that you are like capable of fundraising, it's something between 150 to 400k. The month-over-month growth that you need to show for the investors, it should be rather high. It's normally like 20%. You should be able to grow your traction or revenue. The MRR, again, it's rather optimistic here, but if you're already making like 1k or over that, then the business point is being proven, and the pre-seed can be like conducted. The seed stage accordingly happens in later stage, in later valuations. The figures here are presented as well. And then A and P rounds, and we can continue this table basically till the IPO there as well. But what is like rather essential and the thing I haven't like covered before, it's related to this month-over-month growth, because in the financial planning, you are basically predicting the growth in your volumes as well. Doesn't really matter whether it's the revenue, the profit, the number of users that you are having, but you need to like measure how you are growing annually or month over month. And this percentage criteria here, it's rather accurate. So in the pre-seed, you need to grow like 20%. In seed stage, it's normally 15%. And onwards, it's going to be like a lower growth rate that you should show, but still. And this MRR, or the monthly reoccurring revenue, I mean, if, as I mentioned, you are in quite a good position if you're already making like, I don't know, 1k of the revenue, because it proves the point that the business model is working and everything is fine and we can like scale that. But the more the merrier again. So I definitely like see more and more companies now in pre-seed phase that are basically making like 5 to 10k or 20k revenue over the month, and that can sustain this month-over-month growth rate. So I guess the competition in this pre-seed investment scenery, it has like gone higher as well. So the MRR and the growth rates are a bit higher there. So now to elaborate a bit like how the investors think, and I don't know, let's start off with friends, fools, and family, because they are basically the ones that might invest in your venture in first hand. So basically they are your friends or family or your team members or yourself. So basically the money that you can raise from them, it's definitely love money. So they don't really understand normally the business case or the potential that you have. They just believe in you as a founder or as a founding team, and they want to like be part of the quest that you are taking on. So normally in this very first stage, the tickets or the funding that you can attract, it might be something between 5 to 50k normally. There is like no defined equity model, like what is the valuation of the company and so on, because this isn't normally the first like qualifying financing round that the companies are having. So it's rather emotional, and you can't really put the price label on the company at this very position. But normally it can be up to 5% maybe that you are giving away as equity. You should definitely like mind your cap table, because we have like seen very many cases where somebody in the founding team, for instance, or from the first employees, they inject some money to the company, and you hand away like unreasonable amount of equity for that. And this is always like a rather bad thing, because you can't like change that in later stages. So if you are giving away this equity, then you are in rather bad position. So try to keep that as high as 5% in this very financing round. And please mind the team members or first investors that you take on board, because they tend to be very, very hands-on, and they need to be the people with whom you feel comfortable on proceeding as well. Angels and venture capital funds, they are definitely more institutional and not too much like those hands-on guys there. So those friends, fools, and family in the very first stage, they are the ones that are going to interfere with your like process and growth stages there. So try to keep in mind that they should be like rather good people and with whom you feel a good collaboration happening and things like that as well. But yeah, most of the cases, founders tend to like skip this round. They can finance their like first-hand activities themselves, or they are bootstrapping rather well. So everybody is contributing and putting the free labor in there. And then basically you don't need to maybe have this first initial seed capital. And then it is the right time to maybe fundraise from business angels right away. Business angels are rather good group of people because they are very well organized. In most of the countries, there are business angels network or roofing organizations under which those angels come together and screen the deal flow and make investment decisions. They normally have very extensive and good online communication network and communities. So they are basically interacting with each other, asking advice about different prospects and so on. Angels normally have
excuse me, Martin, can I ask you a question about
yeah, sure.
angel? Particularly as a health tech that we are, and we are also deep tech in the sense that we're building something that doesn't exist yet. We found business angel less knowledgeable about what we do. And in our experience, of course, so my question would be a feedback like, what do you think about business angels for health tech / deep tech? And also they seems to be very connected to the KPIs that you shared, in the sense that in the moment that you are a bit earlier, then even if your business is a bit different in the sense that you cannot not make maybe a lot of revenues at the beginning because you're waiting for the regulatory approval or so on. So we found them, in summary, not a good fit yet for us. This was particularly relevant for the Italian Business Angel Network and the Luxembourg Business Angel Network, because they were very generalist, and although they claim to have healthcare startup in their portfolio, in the end, it was not really like a lot. I don't know what is your experience, and if you suggest us to still contact some, maybe, for example, in France, they have Business Angels La Santé. Now, some invest only local in local companies. So what's your feedback about Business Angels in healthcare?
Absolutely, and I have totally like seen those cases in real market conditions as well, and when we have like made the investments. So one thing that you need to understand is that business angels are not institutional, and they are investing their own money. So basically it's their private money that they're investing in startup companies as an asset group, and they have made this money somehow. And normally they haven't made that in the health tech sector. So they don't understand that too clearly, because the angels that have like long track record and history in health tech sector, or they have worked in pharmacies or some huge medical corporations and so on, they are rather limited. Because of their professional skills, they tend to like stick to those companies for quite a long time period, and they are not like working independently as angels. And they have like very many different NDAs, competition requirements that they need to meet in order to start investing in companies. So this is like rather natural that there are not very many angels that feel themselves very comfortable in investing in startup ventures and especially early stage like health tech startup companies. But I guess the first and foremost advice is that basically investors tend to think in groups, as presented in the slide as well, because they tend to invest in syndicates to lower their own risks. So basically everybody is pitching in the tickets. The ticket size can be like 5 to 50K, for instance. And the only matter there is that whether you can like find this very good, experienced health tech angel that is going to lead this syndicated round. Because let me just bring you like one example. We are right now negotiating one health tech investment. It's going to be €500,000. It's going to be purely made by angel investors. And it worked like that basically the company or the startup that wanted to fundraise, they needed to bring in front of the syndicate 2 business angels, committing altogether only €50,000 from out of this like $500,000 round. But they were very experienced health tech sector, like former founders. One of them successfully exited one company. So immediately they, as the people leading this round, they basically built this trust between this very like early stage startup company and the rest of the angels in the association, for instance. And if this happened, then it was rather easy to get those angels to invest together with them that had less experience, but they just trusted like each other. And if the money commitment is already being made by the people who has like professional skills in this specific sector, then it was like rather easy to put together the round in later stage as well. So, I mean, it doesn't maybe make sense to present your case to a whole group of angels where nobody in the audience or in the room might have no interaction with the business vertical, or they don't have any experience in this business vertical. Maybe it like makes more sense to handpick the one investor that is capable of investing some amount of money, but who basically guarantees that the thing that you are doing is pre-validated by him or her, and they are like ready to bring that in front of other angels to make the syndicate happen as well. So this is something that is as proved to be like working, and it goes to other verticals as well, definitely. But yes, the very fact is that there are not too many like health tech experienced like angels out there, and you need to like handpick them and very specifically find the ones that understand what you are doing very well and that have the credibility to bring this case to in front of other angels in later stages. But yeah, as mentioned, angels tend to invest in syndicates. They want to lower the risks. Normally, the minimum tickets of the angels, they start from €5,000 already. And if the syndicated investment is being made to one company already, then the angels are capable of putting follow-up capital in other rounds there as well. So they might extend their ticket size to 20 to 100K maybe. And normally the angels take the equity something between 5 to 15%, maybe even up to 20% nowadays. It kind of depends on the company valuation again. But the very essential thing is that normally the angels expect to have at least 10x return, and they want to see that rather quickly as well. It doesn't necessarily mean that they want to like cash in this return, but they want to see that the company within 5 years time maximum is capable of growing the valuation at least 10 times, because they are taking these risks in very early stage, where the company is potentially in the very position whether they break it or make it. So they need to like see rather higher returns as well. And this is something that you need to consider again if you are building up your financial like predictions and plans. If you're like presenting the case where you basically waste a lot of money or invest a lot of money into R&D, and there is not going to be any traction in 3 years, then angels normally don't want to invest in there. But if you can show that, okay, throughout this R&D, we can increase we can hold an IP, the IP is rather valuable, and the value might be as high as, I don't know, 10x of the company valuation today, then it's definitely, again, the case for the angels. So try to keep that in mind, that they want to see this valuation growth, and it should be rather high there as well. Then there are organizations or groups like super angels, and basically they are experienced professionals, and they don't do independently angel investments anymore, but they are pooling together the capital that they have. Normally their net worth is something between 5 to 100 million euros, but they have extensive pool of capital at their hands. Normally they are like, I don't know, former startup founders that have exited the companies and so on. So they pool together the money. They have already full-time portfolio management, meaning that they have hired the people, and they normally have the professional team who is conducting the due diligence and everything for the companies and investment cases. The tickets that they are investing, again, rather bigger than the angel tickets, and they are definitely capable to follow up the investments to Series A at least, or even B and C. Super angels tend to take the equity again, like between 5 to 20. They normally want to have anti-diluting protections introduced in the term sheet, which basically means that as they are taking rather high capital risks by investing a very sustainable or good amount of capital in the company, then they normally want to be protected in the following investment round, and they want to have anti-diluting protection, because then already huge like venture capital companies come into play, and they want to be protected at least in the first like investment round. But this is something that has happened quite often, but it's not a thumb rule that they always have this anti-dilution protection there. And expected returns, as they are investing normally already, even together with angels or post-angel pre-seed round, then their returns that they're expecting can be a bit lower. But again, like the position that where they want to like see this valuation growth of the company, it's 5+ years, up to 10 years maybe, and then they consider themselves ready to like exit the company. And then I guess it's VCs, which are the most common like institutional investor group, where you can basically get the investment, especially if you want to have like a long-term investor already on board who is capable of doing this seed, A, B, and C rounds together with you. Again, you need to consider that venture capital companies, they normally have like pretty defined strategies, and it's even shaped by the LPs or limited partners that they have, because normally venture capital teams, they sell the fund idea to limited partners who are putting the money to the fund if they believe in the strategy, and then the VC core team or investing team is going to make the decisions for them. And normally the fund strategy foresees that they are very specifically investing in business verticals. For instance, there are like defined health tech venture capital funds or green technology venture capital funds, and they normally tend to stick to their strategies as well. So they don't want to be off the course too much, because they want to like build the synergy between the portfolio, and they want to like understand very thoroughly like one strategic like vertical where they are making those investments. And normally, the funds are rather large. I guess in this region we see like the funds as high as 200 million euros plus. Normally venture capital funds have a very specific duration, so they need to make all those investments happen in 10 years, because the LPs expect to have the money back after 10 years basically. And normally the active investment phase for those venture capital firms, it's in year 1 to 5. Afterwards, they are just making follow-up investments already in the existing portfolios. So again, like if you approach a venture capital fund that has a quite late maturity stage already, like year 7 or 8, then they definitely or most probably say no, because they don't want to bring in like new deals in their portfolio, and you don't rather they even need to like bother them if you want to like get the appearance or something like that. So you need to understand that the active investment period is in the very beginning if they establish the fund, and if the company is already in the portfolio, then they are making follow-up investments to those companies who perform very well. The tickets that the VCs make, they have decreased a lot because there is a huge competition in the early stages and everybody wants to invest in high returns. So the venture capital funds, just to be out there in later stage, they are already capable of investing like 300,000 or something like that in companies. And normally the fund strategy foresees that, okay, we're going to invest in 30 companies, the ticket of, I don't know, 100,000 or 200,000. And then we screen the portfolio, and the companies that perform, they are going to receive follow-up and so on. So they want to be at the table from quite early stages already. The equity that venture funds are normally negotiating, it's again quite dependent on the valuation of the company. It can be 5 to 30%, depending again on the valuation of the company. Normally the expected return that the venture capital fund sees is 3x, so 3 times the money back. I guess the European statistical average, it's something below 3. It's 2.8, 2.9, something like that, which has happened like in real life. But there are VC funds doing awesome job, like getting the money 10x back and so on. And as I mentioned, the duration of the fund, it's normally 10 years, plus 2 or 3 maybe. And then the venture firm wants to initiate normally a new fund. So they close the first one and open up a new one, take new LPs in and so on. And they are basically trying to then sell the companies that are there in their portfolio and work with that. Then, as mentioned before, crowdfunding is definitely something to consider as well. And especially crowdfunding works very well if you have like 1 or 2 lead investors that are willing to invest in your company, but you don't have like all the capital you need. Like, let's say you try to fundraise 100,000 euros and you have one investor that says that, okay, I'm going to give you like 20,000. Then crowdfunding is something that works rather well as well, because you can approach to very many potential investors rather quickly and very conveniently as well by using like crowdfunding platforms for that. You have the option or opportunity to bend the terms and play around with evaluation as well, because crowdfunding investors, they don't necessarily need to be very industry or they don't need to have like very good understanding about the startup companies or industry specific understanding how those things work. So if they love your product or they love your team or they love your promotional like materials or they have used your product or something like that, then the valuation of your company might go like rather high, and you maybe get the funding with very good terms and attract the funding very, very nicely there. The bad side or the other side of the coin is that it's rather unpredictable. You can like fail with the fundraising campaign, but you can be very successful as well. It only goes back how good of the marketing guy or girl you are and what is the PR that you are like doing there. But basically, if you are very good in the marketing side and the product is something where people can relate with and so on, then those campaigns normally work out rather well, because people are like capable to crowdfund together astonishing amounts of money. And yeah, it's a good opportunity to conduct the sales at the very same time, because those people who invest in you, they can relate back to you. They are potentially going to be your marketing agents. They are going to be the users and so on. So if you need to consider, it's always the valuation. And to be honest, and brutally honest, there is a not very good method or methodology how to put the valuation like number to the company if the company hasn't fundraised anything, because normally the valuation is going to be negotiated during the first qualifying financial investment round. But you should have like some position or understanding what the company might be worth. So you can compare yourself with the competition, like how the competing companies have fundraised, what are their valuations, what is the revenue that they are making, how they have like grown and so on. If you are very R&D specific, then cost to duplicate is something to consider. So how much time, effort, money have you already spent in order to reach where you are today, and what does it take for the competition to follow you? So it's always a good indicator as well. Cash flow method, financial predictions, again, you can rely on the numbers of the statistical numbers or the numbers of the competition. Scorecard method, again, like competing yourself based on specific scorecards on the competition. But a rather good methodology is still like investor negotiations and this qualifying investment round, especially if it's purely private investment that you are like fundraising. This basically gives you this qualifying valuation as well. And after that, the base valuation is already being set, and the follow-up investment rounds are going to be rather easy for you, because then it's the predictions and negotiations are relatively easier afterwards. You should always consider like how much money do you really need, because there is no point of taking in as much cash as possible, because if you don't have a good use for the money, then you are just like overspending, or you are making not too wise decisions there, and maybe you are even ruining the valuation of the company, and you find yourself in a very hard position in the follow-up round to fundraise. So try to be conservative. It's all about this runway management and all the aspects that we described there. The money should be something that brings you next important milestone, because let's say if you want to have, I don't know, expand your revenue from 10K to 100K, and you need, let's say, 500,000 euros to work with very important functionality of the product, then for you, it makes sense to take in this 500K, but there's no point of taking in like 200K, because it doesn't like bring you to the next milestone. And you are again trapped in fundraising again after like 3 or 4 months in order to get things going. And the investors are not too happy because you're under delivering, you can't really like reach the milestone. So try to be conservative and try to figure if this money really like brings you there where you want to be, and don't like overspend, and then don't under like spend as well. Like try to take in as much money as needed. You need to like mind your definitely all these like costs figures, like expansion, traction, product development, marketing, and team costs that you have. You need to foresee that they are growing proportionally as well there. And financial planning is required there for 3 or 5 years, especially if you are like negotiating with investors. And try to predict the time to exit as well, because this is something that investors definitely want to see. And even you might predict the capital that you require in order to reach this exit in terms of fundraising. So try to like fix those things for you at least, and then try to be like pretty brutally honest in doing those things as well. You potentially have a pretty solid fundraising, not strategy, but even position, if you know your growth phase, you know like in which growth phase you are right now, and you know like which are the corresponding investors that are like capable in investing in this specific growth phase. You should be ready for due diligence, because this is something that investors will do. They are going to do the background research. They are going to do the background research for the founders, for the company, the things that you have previously done, what have been your relationships previously with the founding team. If you have like early stage investors, then they are going to ask from the early stage investors whether you have performed or what has happened and so on. So try to make sure that the first response that the new investors end up with wouldn't be too negative, or wouldn't be like bad about your venture company or the founding team. So prepared for the due diligence as well. Again, this understanding where the money brings you. So these milestones, from milestone or KPI to KPI. If you have this like fixed in terms of your product development, sales, and market traction, then present those KPIs. And if you have them ready, then investors love the prospect. The growth expectations. I showed you the slides where the angels are looking for 10x growth in the valuation, and venture firms 5x, and super angels and so on. So try to mind those expectations as well, because there is like no point of asking money if you can't deliver the growth of in the valuation or revenue or profit in your financial plan, because it doesn't make sense for the angels or VCs to invest if you under deliver the expected returns. And then maybe you should like seek for like alternative capital options or match the money with, again, public grants or something like that to serve those opportunities. And again, show the plan how you're putting the capital in good use, because the most intimidating thing that investors normally don't want to see is that, okay, we would sell if we have like a huge budget on marketing or something like that. Like, okay, let's fundraise like 1 million purely for marketing and Facebook ads. Like nobody wants to do that. So you need to have like a solid plan. How are you using and then spending the money wisely? It's always good to have like a solid plan, like what are you going to do with the product development side? What are you going to do with sales and marketing? What are you going to do with, I don't know, in your team or professional like know-how that you have in-house? You can like spread the capital usage around those angles there, and then you maybe end up with rather complex and good plan to proceed. You definitely need to have the hygiene covered, right? So you need to have an awesome slide deck, financial plan. It's always good to have multiple scenarios. For instance, if you are right now in R&D phase and you don't really know what is the exact product going to be that you are going to commercialize, and then what is the business model, how you're going to commercialize that, whether it's like sales or licensing or whatever, then you can always have like plan A, plan B, plan C for different scenarios. And investors love that because they understand that you have thought about the potential risks and things that might happen. So if you have time for that, and if you have different scenarios in hand, then try to play around with them. Investors normally start to ask questions, so there is going to be a pretty extensive Q&A and frequently asked like questions section, and normally how startup companies face that is they just have like the open dashboard where they are covering like all those questions and answers. So if you want to like show this prospect to very many different investors, then maybe they can already find the answer for their question, because normally the questions and concerns they normally tend to be very similar. So you save a lot of time if you have like this Q&A section already established together with your material that you are presenting to investors. Plan and readiness for the meetings and roadshow, like this is rather essential. Like normally fundraising a decent seed around capital, it takes definitely more than 50 meetings with potential investors. It requires you at least 3-4 months of your time. So try to make sure that in your team you have this readiness for holding all those meetings, and somebody's always there responding. Somebody's there who is like willing to travel if needed and meet somebody and so on. So nowadays, most of the investors, they normally start off with online calls and so on. They normally screen the tech, the financial prediction, go over the Q&A maybe. And if they find that somehow interesting, then you normally have the online call followed by a physical meeting. And this all requires time. If you have like simultaneously like 15 or 16 or 17 cases out there, and you are negotiating with very many different counterparts. So legal readiness is something that you need to have basically as well. So try to just make sure that you have like shareholders agreement, NDA signed with the employees. Make sure that the IP belongs to the company, not to the, I don't know, the engineer that is working for you or something like that. So you need to have this hygiene again covered in legal readiness part as well. There are plenty of places where you can find documentation ready-made for you. If you don't have that right now, it's always very good idea to fix that in written form as well. And there are plenty of documentation available for that. And if you are starting to fundraise, Try to make sure that there is like some type of PR or online visibility or coverage about your project, because first and foremost, like if you send in the prospect, the investors are going to Google you, they want to see something positive about you, that somebody has used that, or you're doing great job in product development, you're a very respected team or something like that. So try to have like some coverage about the project, because it's always bad if there is like nothing about you in the Google search engine, right? Closing the investment deal. So well-prepared materials, team members, they are always asking about the commitment, the competencies of the team members. You need to make sure that everybody is on board and happy and willing to proceed. The traction numbers, I mentioned them already. Competitive advantage and unfair competitive edge, like try to compare yourself with as many competition as possible and try to bring out like why you are better, because it's always good to have the competition, because it shows that yes, this is profitable, somebody's doing that already in the market and you are doing something slightly better and you are going to be successful as well. The market opportunity and knowledge, this is like this market bubble I showed you. So try to make sure that you have the understanding about the market, because it's always very, very bad note if the investors know more about the market than you do. Like it doesn't make sense at all. You need to be on top of that, because you are going to be the one selling there. Well-structured action plan and putting the capital in good use. So again, try to build this roadmap, the milestones, the KPIs, what is happening with product sales and the costs and what is the traction you're going to make there, and what are the capital kind of milestones that you want to fundraise in the future as well. And at least have like some ideas about this exit strategy. It might be like maybe some very respected company that might buy you off or whatever. You at least need to have some plan how you're going to exit the venture as well. If you want to close the fundraising, then try to keep in mind that you are running with in like very short runway. So try to fix the time and date when you are really going to like close the investment round, because investors want to see the urgency as well, because if they don't need to commit themselves, then it's always like, okay, it's good that you are doing that, let me know if you are closing the round. So try to present the dates right away by saying that, okay, you need to make the decision not later, but within like 1 month or whatever time frame you are like working with there, and then really close the round then as well. Providing flexible investment option, it basically means that if you are syndicating the investment round, let's say with public capital, then you have one venture firm and business angels that want to invest in you, then potentially they all want to have a bit different and a bit flexibility in their investment agreement. It might be like anti-dilution protection. It might be some kind of premium that they are having in follow-up rounds and so on. It's always reasonable to negotiate all those aspects, because it doesn't really make sense everybody to invest within like same term sheet and so on. It happens, but not too often. So try to be as open as possible and try to like negotiate the best terms for you, definitely, but try to consider like how those venture capitalists or angels are thinking as well, and they might have a bit different expectations on you. Like for instance, angels want to exit your company earlier, venture capital company wants to stick with you till, I don't know, Series C, for instance. So they need to have a bit different options there as well. Always good, find a good lead investor. This was the example that we elaborated on, this health tech specialist who is the angel at the very same time. So if you have like one very good lead investor who is bringing in other investors and basically selling your prospect to venture firms and so on, then you are on the very safe side, and you have like somebody who is like believing in you already. Bring in the advisors if you don't know what to do. Legal advisors, use the programs where you can have like free legal advice or whatever. So it's always good to have advisors who have like previously fundraised and they know exactly what you need to do and what you need to keep in mind. And the legal aspect is rather important as well. So the documentation and everything. Prepare whatever documentation possible, like shareholders agreement, term sheet, IP, due diligence, documentation, stuff like that. They are open documents, can be found everywhere. Pre as ready as possible and try to force the investor using your documentation. And if you can have like legal advisory, then definitely use your documentation to prepare the deal. And then you need to close that and really close that, and setting the dates and being active. This is like rather important point. So very quickly, final tips and tricks. So allocate time. So as I mentioned, if you have like a solid runway, at least for half a year, then you are in a very good position to fundraise, and try to like assign team members, maybe even full time, to do the fundraising, because it takes time. It takes a lot of meetings, a lot of interactions, and it can't be done like half time or maybe part time. Very good. So try to allocate resources for that. Handpick like the most suitable mix of investors. Like if you want to have different or very specific know-how, for instance, try to find only those angels that have this know-how, or venture firms that have this know-how, because they come with a very good like additional value as well, besides the money, and they feel convenient in your business sector and vertical, and the deals might happen most likely. It's always good to overmark your investment round. Like you take in like more interested, committed investors, then you are like closing the deal, because let's say if you want to fundraise €500,000, then at some point you might find yourself in the situation where already investors have marked like, I don't know, €1 million, and then you need to, or you are able to make the decision whether you only take those angels or investors that are the most relevant for you and leave the others aside, or you extend your milestones and KPI plans to take in additional money and maybe work within a longer time period with the capital. So it's at least then you have the option. Protect the cap table as you can, because professional investors are rather safe. Angels are safe, VC firms are safe. But if you interact with, I don't know, some companies or individuals that haven't done any startup investments in their life, and this is the first case, then they want to very much ruin the cap table and ownership structure of the company, like taking, I don't know, 40% of the equity. And in later stages, it doesn't even make sense for additional external investors to jump on board, because the cap table is ruined for them. But if we're talking about professional investors, then they know that the company requires other fundraising stages as well, and they are not over negotiating their like equity or how much equity they're holding in the cap table. And it's rather safe to enter the deals with them, because they don't want to ruin the things for themselves as well. And find experienced people and use lawyer. It's pretty obvious. Money always comes with a trust. So if you can like go through the network that already knows you, and then maybe you find angels from this group, it's always like safer. As I mentioned, investors, they are more about saying no, and approach only the ones where you feel like that there is the match. Like go over the portfolios of venture capital firms, check out Crunchbase, Angel Database, LinkedIn profiles, for instance. And then if you see that, okay, there is the specific business angel that has like invested in similar companies like yourself, then work with him, like meet him or her, and then try to start with those like field specific investors right away. LinkedIn and intros are the best. So if you know people who can introduce you to investors or angels, then it's always better than having cold calls. It's obvious, I guess. 150K around, it requires 50 to 70 meetings. So be prepared for that. And if you have like, if somebody has, or investors have said you like, I don't know, 20 times no, then nothing bad has happened yet. You still have like, I don't know, 30 to 50 meetings ahead of you. Field specific capital is normally hard to find, but it's easier to close. So again, venture firms used to invest in health tech sector. Angels used to invest in health tech sector. There are not plenty of them, but if you can have their attention, then it's rather easy to close the deal, because they know what they are doing, and the negotiations go like far more quicker than with generalistic investors. And yeah, private public capital mix, like try to set it up as possible because public capital is cheaper. You are going to have the session on public capital opportunities as well. And if you can find a good match there with private investors, then try to use them like simultaneously. And I guess that's it. Oh yeah, we have like 1 minute left. I was already worried that we're going to exceed the timeline. But that was it. I hope it was a bit helpful, and I hope it helped you somehow to prepare for the one-on-one meetings as well. And again, like if you want to ask something right away, I'm more than happy to answer. But if you want to like send in the financial predictions that you have so far, send them in as well. I'm ready to go them through, and we can already like discuss these things like more thoroughly during our one-on-one sessions. So yeah, thanks.
Thank you, Martin. Does anyone have any questions?
Oh yeah.
Thank you, Martin. Sorry, I have one last question. If there is time, if not, we can discuss. I think it's tomorrow.
Yeah. There is. We have exceeded our time frame a bit, but I mean, nobody minds if we have a couple of questions.
Okay, so particularly because this question is more about fundraising and less about the financial plan. And this question is the following. So you mentioned that normally it takes 6 to 9 months and a different ticket size. My question is, what do you think about a strategy in which we close first fast convertible on a overall round of 1 million? Maybe we close first 200 of convertible note with a discount with a first business angel or a small family office, so that we actually have more time, more runaway. And of course, because this small part of the round will allow us to, for example, for us to bring the product to the market, to have more time to fundraise without stress, and then delay, let's say, the rest of the round, maybe 800K of many months. What do you think about this kind of stuff?
No, I mean, strategically, it really does make sense because it lowers the risks for everybody. Basically, investors want to see how you perform, and then they want to invest in smaller tranches because they want to like be sure that you're really like delivering what you are like promising there. You potentially have lower risks as well because larger amount of capital being like assures you like longer runway, but very many things might go wrong like during that time period that you have because you are in very early stage, and then things happen in product development and so on. But if you see that, okay, your capital requirement is altogether 1 million euros and you want to like make that happen in tranches, then the only concern that you need to keep in mind is that the table I show you, where you need to like basically present the results and KPIs, like what is the month-over-month growth, or what is the traction, like how many interested customers, whatever you can achieve with the money. It's very, very important for the investors, and you need to be like pretty like honest about that, because if you fail with the first tranche, then it's very unlikely that they are going to trust you in the later stages and then granting you additional funding. So be like very like conservative with the KPIs that you are presenting there, because it's mostly about that. And if this 200K brings you to some measurable and reasonable KPI that you can present, then it's possible to do that in stages. But if basically this 200,000 euros get you nowhere, you still like spend all the money on R&D and you don't have any like solid results, nor have you like any traction on the market, then it's very hard to understand like should we invest additional 200 or 300 or shouldn't we? So if you can like deliver something based on the first tranche of money, then yes, do that in stages. Everybody wants to have lower risks there. But if you can't deliver any meaningful KPIs, then it's rather complicated, and I wouldn't suggest you to fundraise less money than you actually require.
Okay, thank you.
Yeah, but I guess if we have like this one-on-one, then we can like see the case, because I don't know right now too much about the product and concept. So, and what are the opportunities for you to actually present the traction, like how complicated is the sales cycle or commercialization cycle and so on.
Yeah, definitely we can discuss more into the one-to-one, because my question would be also, because now I started to fundraise and I started to pitch the entire round, and then I end up actually in a business angel who have a small ticket size of 100, 200K. And so I'm thinking, okay, but I mean, he could be fast, but either I present him, okay, we close first 250 with a discount and then the rest later. Or if I don't present in this way, he's not putting the money now, he's putting the money when we close the round. So in this sense, we had to present, and then the plan that we present, should it be the same? So to a big investor, should I say, yes, we plan to raise 250 first, or should be different if I speak with smaller investors or big investors?
No, it shouldn't be different, because as I mentioned, like bigger investors, like venture firms, they are like willing to invest in lower positions as well, just because they want to be with you in the later stages. And it's really okay. Like if you have like this realistic approach on your fundraising plan, and you say that, okay, we don't want to take too many or high additional risks, and we just want to like conduct like this first part of our growth strategy or plan, and we require 200K, and if we achieve that, and those are the KPIs that we are going to achieve, then we have like a follow-up round where the valuation is higher and where we are taking in additional, let's say 800,000 or something like that. Because if they believe in this very plan that you have, and they see that, okay, you have like thought things and figured things out, like how you're going to do that, then it's nothing that shouldn't like be at their table, or that they should find like, okay, well, I'm not doing that because the capital need is low or something like that. So they definitely want to stick with you, and you shouldn't like present different plans like for different investors.
Okay, thank you so much.
Okay, does anyone else have any questions?
Okay. Cool.
Seems
But
not.
then I guess starting from tomorrow, we are going to have the one-on-one meetings, and then as mentioned, like, yeah, if somebody wants to send something in, do that, and I'm going to check that later today, and then be prepared for tomorrow then.
Thank you, everyone, and thank you, Martin, so much as always. Great to see you. Great to see you all, and let's catch up later.
Thank you.
Yeah.
Bye-bye.
Okay,
Thanks.
thank you. Bye.